distinguished members on the dais, and ladies and gentlemen. The biggest changes in corporate regulation, and a lot of times those dealing with accounts and auditors and all of that, have always been triggered by some of the other accounting scandals. So be it the Enron, which triggered the Sarbanes-Oxley Act in the US. And I think what we've seen here is no exception. I think the Companies Act 2013, in a lot of respects, is India's answer to Sarbanes-Oxley Act. In fact, what started off 10 years back as an effort to revamp the Companies Act was essentially a step towards making it more contemporary, more in sync with the business realities of today. But with the events that happened over the last 4 or 5 years, starting with Satyam and the number of other scams that have impacted both the government as well as the corporate sector, I think the whole color of the legislation has taken a significant change. And ultimately, it's now, I think, resting on a backbone of governance with increased transparency, higher accountability for the stakeholders and the various people involved in the corporate ecosystem, be it the directors, be it independent directors, be it the auditors. So I think what I'd like to touch upon is, so while we spoke of the 6 critical themes that the whole Act kind of crystallizes all of their changes into, I think I'll touch upon the first 2, which is the rigor on increased reporting framework and the higher auditor accountability. And I'll preface my comments by saying that while all of these changes are broadly in the right direction, but some of them seem to be bordering on the on being a little excessive, partly because they are more of a knee-jerk reaction to what happened in the corporate sector. In some sense, it also feels like these were rules written to deal with the exceptions, with the outliers, or with the aberrations, rather than dealing with the norm. But that is the state of the law as it is written, and the draft rules as they're kind of taking shape. And I think that's the reality that we have to live with. Some of these changes are also likely, especially the changes relating to the auditing profession, also likely to bring across a tectonic shift in the profession itself. Both structurally, in terms of the way the whole profession is structured, and the way the entire practice is spread across the large to the medium and the very, very small practitioners. And also on the behavioral front, I think we'll see a lot of change in behaviors in the kind of people involved within this whole process. So moving to some of the changes that impact financial reporting and the overall reporting framework. Obviously, there are changes that have been focused on the external reporting requirements. There are also changes focused on the internal reporting. So one of the changes is on the financial year end now having to be a uniform period, which is a year ending March 31. Of course, I think one of the objectives of this was to make sure that there's more consistency and uniformity in the way companies report financial information, but also brought in as somewhat an anti-abuse provision to prevent companies from frequently changing financial year end to meet financial reporting or other objectives. So it's certainly now companies will have to stick to a 12-month period, always ending on March 31, just like we have for the tax purposes, and report on that basis. Of course, there are some exemptions being provided to multinational companies and their subsidiaries operating in India when the parent company needs to follow a different year end. So then they are allowed to, of course, apply to the tribunal to follow a different year end. But again, I think the key driver here seems to be to of course, avoid any kind of abuse of the ability to change year ends frequently, and to bring in more comparability and consistency. The other big change is on companies now having to report financial information on a consolidated basis. So it's not something new for listed companies. I think under the clause 41, they've always had to report information for the last few years on a consolidated basis. But what the Act does is actually go well beyond that. It now requires even private companies to report information on a consolidated basis. That's a big change. The second is it requires, so under the listing agreement, it's only the listed entity, which is the ultimate holding company at that level, which is required to present information on a consolidated basis. But under the new requirements under the Act, every single layer within that, so every intermediate holding company will also now need to present consolidated financial statements. Again, this is not international practice, because internationally under whatever standards, be it US or international standards, intermediate holding companies are exempt from presenting consolidated financials if the ultimate parent presents information on a consolidated basis, unless they have their own equity securities or debt securities that are listed. So this again goes beyond what's the international mandate, but again, the reason being, like we saw in the earlier section, I think there's a lot of focus on regulating kind of intra-group transactions and holding subsidiary kind of transactions, the flow of funds and all of that. So there seems to be a effort to kind of regulate that, and I think bring in more transparency into what consolidated financial statements look like at each level. And I think that seems to be the intent with which the government's going here. The third change is hitherto, under the listing agreement and the related accounting standards, if a company did not have a subsidiary, it was not required to present consolidated financial statements. So if a company operated only through a bunch of associates or joint ventures, they didn't have to present information on a consolidated basis. But what the new act does is that even if a company does not have a subsidiary, but it has joint ventures or associates, you're required to present information on a consolidated basis. So overall, the theme seems to be to bring in more transparency, more relevance in the financial information that is being reported. But at the same time, with the requirement to present at intermediate holding company levels, I think it also borders on being extremely burdensome for companies. The third changes are relating to the revision of financial statements. So hitherto in India, I think once financial statements have been adopted by the shareholders, there was no room to reopen those accounts except in very, very rare circumstances. But what this opens up is now a window for you to actually reopen your past year's financial statements, make corrections. And this is possible on two fronts. One is when there's a regulatory intervention, and the other is a voluntary revision by the board of directors. Now, the regulatory intervention is interesting because it could be triggered by SEBI, by the central government, by tax authorities. So if they have reason to believe that the information presented was fraudulently kind of reported, or if there's a mismanagement in the affairs which casts doubt on the quality of the financial information, they can actually require companies to restate their financial statements. Now, again, if you just read this together with the definition of fraud, which is in section 447, which is a very wide, very vague definition of fraud, including, let's say, any intent to deceive or any other person. So even a tax authority could turn around and say that there was an attempt to avoid, let's say, payment of MAT or payment of tax or offer income to tax in a particular year. Could this be used as an opportunity for them to get companies to reopen accounts, etc.? I think those are big questions that come in front of us. The other window is for the directors. So if they come across errors in financial statements, etc., they have the ability to now kind of require companies to restate financials, but of course that window is open only for a 3-year period. But on a regulatory intervention, this can be open for any number of years. It doesn't state the limitation in terms of how many years. This also kind of operationalizes a recent move by SEBI to start looking at qualified audit reports of companies, and where they have reason to believe that the qualification in those audit reports are justified, they would require companies to restate financial statements. So this actually now enables to SEBI to actually make an application to the tribunal to actually require the company to do that restatement, which was not earlier permitted under the 1956 Act, and therefore SEBI came out with a clarification saying only a pro forma disclosure needs to be made. Now it'll actually end up with a full restatement of those financial statements. A related challenge also comes that when you have restatement of financial statements, it needs to get re-audited. Now the draft rules say that when a re-audit is done, it's the present auditor of the company who needs to audit those financial statements. Now, audit rotation, we all know, is also a reality. So when you read the two together, it could be a new auditor who's come into the company who now needs to re-audit financials, let's say, of 3 years ago, which was audited by somebody else. So essentially, he will need to re-audit the entire thing because he can't just audit on that one element of restatement. And when a restatement happens, it's not just that 1 year that gets impacted. You need to restate every subsequent year, which has also got impacted. So you could end up with situations of 3-4 years having to get restated at the same time, need to get re-audited at the same time, then put it all through the shareholder approval. So in some sense, a fairly cumbersome process that could result from this. But nonetheless, I think it's again a move in line with what's international practice in terms of restatement of financials. Some of the other changes are relating to the way companies report depreciation, because hitherto Indian companies have generally followed Schedule 14 rates as the rates irrespective of what the actual life of the assets are. But the Schedule 2, which is the schedule that corresponds to Schedule 14, now brings in this concept of useful life into the schedule itself, and also brings in a concept of component accounting. Now, for a prescribed class of companies, and that the rules have still not prescribed what that class of companies is, but they can essentially follow a life which they believe is the useful life, irrespective of whether it is longer than or shorter than the life prescribed in the schedule. They just need to provide a justification. So, for instance, a power plant which runs for, let's say, in the estimate of management for a 35-year period, doesn't need to now get depreciated over a 20-year period as was the practice under the earlier act. They can now use a 35-year life, so that's the positive of that. But for companies that don't get covered in that specified class, they can only use a life which is as per the schedule or a shorter life. And that's where again the problem comes, because for some class of asset, for instance a continuous process plant, earlier the life prescribed was about 18 years or so. Under the new act it's 8 years, which is almost less than 50% of what's there under the existing schedule. So companies will have to essentially watch out for which class of companies they fall into. If they fall into the prescribed class, then I think it's a good schedule for them, because they can effectively reflect what is the accurate reflection of the pattern of use of the asset. But if they don't fall into that prescribed class, I think this schedule does hold some complications for them. The other big change is on the internal control reporting. So companies have I'm sure all of us have heard of Sarbanes-Oxley Section 404, the SOX 404, which is the internal control reporting requirement under the US Sarbanes-Oxley Act. Well, the requirement here actually goes well beyond that.